Remember guys, Movement Mortgage 671. That's 6 hours in underwriting, 7 days in processing, and 1 day in funding. How can they do this? They've got their systems. And Remen is looking for account reps who've got experience. Listen, if you're looking at making a move over there, you might want to talk to Remen. They've got great products for you. All you have to do is click this banner right over there. If you're on Facebook, straight up above. All right, guys, MGI Bulletin 01-2018. It's the first of the year for Magic, and hopefully not a sign of things to come. It says, we are concerned. They're concerned with the recent increase in loans that have debt-to-income ratios, DTI ratios, exceeding 45%. Interesting, isn't it? Particularly when combined with weaker credit profiles. And as a result, effective with mortgage insurance applications received on or after March 1st, we, being MGIC, will insure loans with DTIs exceeding 45% only when the representative credit score is 700 or greater. So, is this a big deal? Well, it's the first pullback in the mortgage market in over a year. It's the first time underwriting has gotten more conservative, as if we have become too liberal, too risky in our underwriting analysis. Now, at issue is what I've always said about the last meltdown. All these great prognosticators who analyze the industry, they blame the meltdown on giving loans to less than credit-worthy borrowers, or the fact that borrowers didn't have skin in the game. You know, with those 100% LTV or even 125 LTV deals. Now, the problem with that analysis is, if you couldn't afford to make the payment because your payment reset, because you had margins of 5, it didn't matter what your credit score was or how much money you put down. Because if you couldn't make the payment, the deal was gonna default. Now let's flip that. If you had bad credit or had a 100% deal and your home is underwater, but you could still make the payment, then there's a pretty damn good chance that you would in fact make that payment, now isn't there? Because after all, moving or getting foreclosed on sucks no matter what your score or your LTV was. In short, the ability to make your payment is the most vital indicator for future foreclosure. Now MGIC is concerned that we become too aggressive with ratios. In their words, we are concerned. So what does this mean for you? Well, first of all, I'd expect other MI companies to follow suit in the near future, or at bare minimum to increase their MI on clients who have higher than 45 DTI ratios with scores less than 700. And second, but more importantly, if I were you, I'd start qualifying folks with back-end ratios that do not exceed 40. After all, a $400,000 house always looks better than a $350,000 house. And because borrowers almost always want to push their max qualifying ability when they start looking at homes, a starting point of a 40 or less back-end ratio gives you a little wiggle room and keeps you away of problems with higher mortgage insurance on your files. Keep in mind, your borrowers, they like the more expensive home, but they don't necessarily like the payment that comes along with it. And if you're adding premium priced MI on top of that, it can get ugly really quick. Remember, you have till March 1st, so plan accordingly. So we saw that Guild Mortgage, they just bought Cornerstone Mortgage. They're a St. Louis-based mortgage company of about 100 loan officers. So if you've ever been a loan officer for a company who's been purchased, you know exactly what's going on right now. Your phones are ringing off the hook with overpaid headhunters, isn't it? Listen, if you want to talk to somebody who doesn't have a dog in the fight, okay, you can reach out to us by clicking on the link down below. We can offer you some solutions to your situation, but truthfully, you might just want to stick with Guild. They're a great company with a great reputation. And finally, the Stock News Gazette asked the question, should you invest in Wells Fargo? Well, the answer is no. And now that the year's over, we're beginning to see just how much of a mess 2017 was for the stagecoach. Residential mortgage loans originations were $53 billion in the fourth quarter, down from $59 billion in the third quarter of last year. Mortgage servicing income was down to $262 million in the fourth quarter from $309 million in the third quarter. Wells Fargo paid a total of $3.25 billion in pre-tax expenses for litigation accruals on a variety of matters, including but not limited to mortgage-related regulatory investigations, sales practices, and other consumer-related matters. And they plan to close 800 more branches by 2020. Ouch. Now, they've been bad, and sure, regulators are holding their feet to the fire, but I just can't help but thinking, 800 fewer branches, it just means more of a hassle for those who bank with them. And Who are the regulators, guys? Who are they really hurting here? Well, how about the employees of those 800 branches who did nothing wrong and now they're going to have to look for work elsewhere? Not the board, not the executives. No, they're going to be just fine. As always, it's the customers and the folks at the bottom who really pay the price, isn't it? It really makes you wonder if just finding these companies is the best solution for the problem. Hey guys, you'll have me and Frank back tomorrow. It's been an interesting couple of weeks. We'll just put it in one word: flu. We've had a lot of it lately. So if you're meeting us for the first time, subscribe. We're gonna give you great industry news every single day, maybe a little sales nourishment to help you out. If you do like what you're seeing, forward this on to other people you know in the industry because it helps us out. And make sure if you're doing it on your social sites to tag other people so they can see it too. Thank you so much, and we'll catch you manana. Later.